Dear investor, Edelweiss Private Wealth Management is pleased to present you the latest issue of Investment Strategy Report for October 2018. Let's take a look at key highlights of September. The US-China trade war has intensified further, with the US slapping tariffs on Chinese goods worth $200 billion in addition to $50 billion imposed in July, and China set to retaliate in equivalent measure. The Indian rupee continued to make new lifetime lows, touching 72.97 during the month, closing the month at 72.49, declining by 13.49% in this calendar year on account of deteriorating external balances and rising global yields. The US Fed hiked the federal funds rate in its policy review on the back of strengthening economy, falling unemployment, and stable inflation expectations. Brent crude prices hit a 4-year high of $82 a barrel, led by supply disruption worries due to impending Iran sanctions and OPEC decision to maintain the current production target. The current account deficit for Q1 financial year 19 came in around $16 billion, a 4-quarter high at 2.4% of GDP, while trade deficit in August remained elevated at $17.4 billion. Nifty witnessed 6.4% fall in September, led by fear of liquidity squeeze and major events like IL and FS downgrade. RBI's denial on tenure extension to Yes Bank's Rana Kapoor and sharp correction in NBFC basket post DHFL commercial paper sale by a fund house at a discount. Index of industrial production for July 2018 came in at 6.6%, in line with the June print of 6.7% on account of low base due to pre-GST destocking in June 2017. Although some healthy growth in earnings was seen last quarter, earnings downgrades were still abound. Sustained recovery in earnings is needed to support the high valuation of Indian equities, which remain overvalued compared to their peers in the emerging markets. We expect headline indices to face increasing odds of a deep correction of 10% or more, or be range-bound at best. We revise our Nifty target range to 11,500 to 12,000 for December 2019. EPS estimates for Nifty index for financial year 19, financial year 20 and financial year 21 are Rs 578, Rs 691 and Rs 796 respectively. As per blended estimates, index is currently trading at PE of approximately 17.5 times 1 year forward. We recommend investors to deploy 25% of fresh equity allocation, while the remaining can get invested over a 5 to 6 month period in a staggered manner. The 10-year benchmark GSEC is hovering in the range of 7.95% to 8.18% on a semi-annualized basis. Bond yields have seen aggressive rise in the last few weeks on account of depreciation in the INR, widening fiscal deficit, liquidity squeeze, and rise in US Treasury yields. Government cut its gross borrowing for the year by Rs 70,000 crores to Rs 5.35 lakh crores, sending a strong signal for fiscal commitment, even as fiscal deficit for April to August period came in at 94.7% of government's annual target. RBI provided a liquidity boost by conducting 2 back-to-back open market operations purchase of Rs 10,000 crores each in September and announced Rs 36,000 crores open market operations in October. In addition, it allowed an additional 2% dip into statutory liquidity ratio to banks for the purpose of liquidity coverage ratio maintenance. The CPI inflation grew by 3.7% in August compared to 4.2% in July, led by softer food prices, while fuel and core prices indices remain elevated. We expect benchmark yields to remain volatile and trade in the range of 8.00% to 8.25% with an upward bias of 25 basis points. Yield movement hereon will depend on inflation trajectory, currency movement, crude oil prices, and global bond yield movement. We expect the MPC to hike policy rate by 25 basis points for the third time in a row in the October policy review, while maintaining a neutral stance guided by firming crude prices and rapidly weakening rupee. We recommend investors to allocate 100% of their fresh fixed income allocation to very low duration offerings, overnight and liquid funds, arbitrage funds, high quality roll down and buy and hold strategies, structured products, and long-term regular yielding infrastructure strategies.